Welcome options traders, hello everyone. And I wanted to create kind of a brand new series of videos here on some technical analysis and technical indicators. I've received several emails from people saying, hey, what's this MACD or this Williams percent R, stochastics, RSI, all these different things that I can overlay on my chart. And more importantly, how do I read them and make use of them? So let's start off with the first one here, one of probably the most popular one called the MACD, which stands for Moving Average Convergence Divergence. So first of all, for everybody who's new, what we're talking about is technical analysis. And really what that is, it's just a method for forecasting stock prices. We're mostly looking at price, volume, chart patterns, things like that. Contrast that with fundamental analysis, where we are considering cash flows, financial ratios, accounting data. So technical analysis or technicians or chartists are people who look at either pictures or different ratios, different indicators trying to predict where stock prices are going. All technical analysis is based on three key assumptions. First of all, that the market discounts everything. In other words, it's all factored in there. Prices move in trends. It's not totally random. And then finally, history repeats itself. So if we see that the stock typically bounces off of this level as a support or a resistance level, we can expect it to happen again in the future. Now let me also just say, just to caution you, that technical analysis is far from perfect. The main reason that it works is because everybody thinks that it works. So it's just kind of a herd mentality. But obviously that's part of the trick. Remember, it's not about what you think that's going to happen that matters. It's what everybody else thinks. And so we can certainly get some insights by looking at some technical indicators. So let's start off by looking at MACD. Most of your platforms will allow you to put this on very easily. It's actually what's called a lower study because it's going to be put on a chart below your actual stock chart. So you can see I've got some moving averages here in red and blue. I'll talk more about those in a moment. Those are called upper studies because they actually overlay the chart. But for the E-Trade platform, all I have to do is come up here to this drop-down menu that says Studies, and there's MACD right there. Click it. Here are the defaults. You can change these. I'll talk a little bit more about that in a moment, but the defaults, I would, for right now, leave them. 1226, and then your signal line will be 9. Click on Save, and there's your MACD. Again, a lower study. So I'm going to lift this up right now just so we can see it better. And the thing I want you to focus on now is that there's really three key elements to MACD. First of all, I've got this black line right here, which is actually called the MACD line. We have a second line here, this red one, which is sometimes called the signal line, and that is just a moving average of the black line. And then finally, another area that we'll look at is this zero line right here. You can see that lines up at 0 over here, and we'll look at some crossover patterns that occur at 0. We also have this histogram. Now, some of them will show it, some won't. Some might allow you to toggle it on and off, but we'll take a look at what this histogram is as well. So let's go ahead and break down MACD. Let's start by looking at the MACD line. That's probably the most important one, which is this black line. So to make it easier, I'm going to actually, let's make the signal line, we'll make it white, just to kind of erase it there. So your eye can easily see this black line. And what this is, the MACD line, it is simply a difference of two different moving averages. So let's go back up to our stock chart. And the default that we had on there was the 12 and 26. Remember, you can see back here, it was the 12 and the 26. Those are the two different moving averages. They are exponential moving averages, which is usually the default. You can make them simple if you want. An exponential moving average just gives a little bit more weight to the current prices rather than the past ones. But over a 26-day period, not going to make a big difference. So right now I've overlaid the 12-day moving average here in red with the 26 in blue. So for everybody who's new to moving averages, the lower the number, or the lower the period that we would call, whether it's a 12-minute or a 12-day or whatever the period is that we're looking at, the lower the number, the more volatile it is. We get more zigs and zags. So you can see that this red line has more twists and turns in it than the blue. So that's a very quick way to tell that the red line is the 12-day and the blue is the 26. So what this black line is doing down here is it's taking the value of the red line at this moment in time minus the blue. So for example, let's say right here at this point, this maximum point right here in black, if the red line moving average, let's say, was 1500 and the blue line was maybe 1440, that's a 60-point difference. And that's what this line is showing you right here. It's lining up right over here at 60. So once again, the black line is simply telling you the difference of the 12 and 26-day moving average. So the first thing that they're trying to do here is to say that moving averages usually kind of show you the trends, weed out a lot of the noise and just show you the overall trend. But then by looking at the difference, it can also show us momentum. Where are the prices moving right now? So when you're looking at this black line, the MACD line, anytime it is above zero, remember your zero line is right here. Anytime it's above zero, it tells you that the red line is above the blue. Now, you don't even need to have these on your chart. I just did this to make it a little easier to visualize. But you could do different moving averages on your chart, but still use the 12 and 26 on your MACD. So anytime, again, that this black line is above zero, we know that the red is above blue, or 12 is above 26. However, take a look what happened over here. You can see a crossover. The red line came from the high side, crossed down through the blue, and right where they cross, take a look at what lines up down below. It lines up exactly at zero. Why? Because the value of the red minus the blue is zero. They're the same value. So anytime that this black line down here crosses zero, it tells you that your short-term moving averages up here have crossed. So if they have crossed from the high side down, in other words, the red line has crossed from the high side down, what does that tell you? Think about it. The red line is your 12-day moving average. The blue is the 26. So if prices more recently over the past 12 days on average are moving in a downward direction, then the red line is going to pick that up sooner. And so it's telling us that on average in the past 12 days, prices are doing worse than they have over the past 26 days. Something has changed. We're seeing a shift in momentum. So again, without having to look at the red and blue line up on top, all I have to do is see the black line, the MACD below. And if it crosses from the high side down through zero, right when it crosses, that is one type of signal. Now, this is actually the second most popular signal. I'll show you the first and next, but since we're talking about the MACD line, let's go ahead and start here. This is a very basic MACD signal. MACD line crosses from the high side down right where it crosses zero, that we would say it's probably going to be a time when prices are starting to slow down and maybe head negative a little bit. Now, on the other hand, what happens when the MACD line is below zero, such as here? Well, you should know intuitively that that means that our moving averages have flipped, and the red line is now below the blue. Okay, so in other words, red minus blue is a negative number. And so the black line is going to sit below zero. However, if the red line crosses from the bottom up this way, the short-term moving average is crossing the longer-dated moving average here. Again, we would line up at zero down here. But we've moved from the low side, from below zero to above zero. And so we would now have the opposite opinion and say, well, the momentum is now shifting. So on average, we are seeing over the past 12 days more price increases than we have over the past 26 days. So again, something has changed. We are seeing money flowing into the stock. We're seeing prices starting to rise. And that would be a signal when the black line has crossed from the low side up. And that would correspond to a cross with the short-term moving average crossing from below up. So let's take a look at some of these signals. Let's go back here where the first one crossed. All right, you can see where we crossed zero. That would have given you a signal. Now, here's one of my first complaints about really all technical analysis. It's such short term. So yes, you might have caught this little dip down here. Of course, if you were playing puts, you still might have lost depending on volatility, but you might have caught that little bit. But look what you missed. You missed the run from 1,300 to well over 1,700. So, again, it's really for very short-term trading. I like to use it as a way to enter into a position, even though it might be a longer dated position, but use it to scale in, hedge, roll, morph, use it for helping in your determinations for those points in time. Now, if we look over here, where the black line came from underneath and cross, that might have given us a buy signal. And if we line up over here, got a few candles up, came back down, but then overall seemed to go on this nice upward trend up here. So that's the MACD line, this black line. Now, another little point about the MACD is that it is what's called an unbounded indicator. We're going to find out when we look at future ones such as RSI and Williams percent R, things like that, that they are bounded. They're normalized to fall between 0 and 100. That's not true for MACD. So you really can't use it as a relatively overbought or oversold. I wouldn't look at this and say it's really overbought. I don't really know that by looking at MACD. And down here, I wouldn't say that it's necessarily oversold. Once again, it's because it's unbounded. I would use these as turning points in that stock before I would use them as overbought and oversold conditions. But that's the MACD line, so now you've got a better idea of what that is and how to use it. All right, let's go back and talk about our signal line now. I'm going to put this back on here. We'll make our signal in red. And what this signal line is down here is just a moving average of the MACD. And like I said before, anytime you use a moving average of some variable, it's going to be a slower or it's obviously going to be a lagging indicator. So this red line is going to move slower than the black, because it's a moving average of the MACD line. So the primary way that traders use the turning points, first one I just showed you was with if you just focus on the black line moving above or below 0. But more common is for people to look at when the black line crosses the red. So for instance, this point right here, black line, MACD line crossed through its moving average from the high side down, and we would say that that's probably a point where we're going to get into a turn in momentum. We're going to see this starting to fall. And you can see it actually lined up with a little bit of a dip in the stock prices down here. The benefit of that is that you're going to get earlier signals by watching these crossovers as opposed to just looking at the MACD line crossing 0. Another property about moving averages, kind of a little interesting note here. Notice that how the black line crossed from the high side down, it intersects it right at a relative high. And that will always be true. Look down here, black line comes from below the red, intersects it at a relative low. In other words, the black line must be crossing up above the red before the red can start getting pulled up as well. So it always has to cross at either a relative high or a relative low. So again, as a recap, your first signal with MACD is looking at a crossover between your MACD line and your signal line. That's why they call it a signal line. So this point right here would say, all things being equal, this is a pretty good time to buy. And you can see it was a pretty good signal. Back over here, where the black line crossed from the high side down, might show that the momentum is starting to fall. And take a look right here, pretty close to that little peak. Might be a good time to maybe roll our positions, do an overroll, go into maybe sell half and go into a 35 or 40 delta. Get most of that money off the table, but still stay in just in case it runs. And if it doesn't, we can take those same dollars, buy them back in here, have more deltas for the same money. So you can always come out ahead as long as you're doing some type of a hedge, roll, or morph. And the technical indicators will help you to make those decisions. All right, now that you understand the difference between the MACD line and the signal line, you can see what the histogram is for. It's fairly simple. It's looking at the difference or the gap between the black and the red. So for instance, take a look right here in this little segment. You can see the black line sits above the red, and therefore this histogram, this little hump right here, will always sit above 0. But notice that the gap isn't always the same size. We got a little, very small difference down in here, then the difference is getting bigger, and then we start getting very smaller until we eventually cross. So if you look at these colored bars, the size of this gap is getting bigger, and then right there, yes, the black is still above the red, but the gap is getting smaller, and that's why this bar turned red. And then over here, we turned negative a little bit. The black went underneath the red. That's why the histogram went under. And so it's just showing you when you're going to see possible changes in the momentum. So in other words, if you see that the histogram is all above zero, as in this case, but it changes from green to red, it means that it's increasing, but it's increasing at a decreasing rate. This gap here is getting smaller, and that's why these bars are turning red. So the histogram just gives you a little bit better visualization of what's actually happening between your MACD line here in black and the signal line in red. Now the third indicator, really the least popular of these with MACD, is called a convergence or a divergence. And so what you're looking for here, for example, on Amazon, let's say that the stock, let's say between these two periods here, see this black line is kind of at a high, and we're still at a high here, but it's at a lower high. So if we drew a line between these, it would look like this. Okay, it is moving higher, but it's at a lower high. However, look at the stock price between those 2 points. It actually moved to a higher high. So that might be a way of showing that yes, MACD did rise, but it didn't rise as far. It increased to a lower high. So that's what we would call a bearish divergence. So even if you were starting to see this bearish divergence right here starting to form before the crossover occurs, it could give you some insights into thinking this might be a good time to hedge our position. A bullish divergence would be exactly the opposite. You're going to see that the stock has made a lower low, but your MACD actually made a higher low, and that would be a bullish divergence. So I hope that gives you some pretty good insights onto MACD. Try it out for yourselves. Let me know what you think, and we'll post some more videos here going forward with some new technical indicators for you. And for anyone who'd like to learn the art and science of options trading, please join us on the Facebook trading group Options A to Z. It's a free site. We'd love to have you join.